Hi guys, thanks for joining us again today, and we've got Jay Pace from Providence Property and myself here, Tuan from Tax Quantity Surveyors. We've gone through obviously a very unusual time of COVID-19 now coming along in the last almost 12 months almost. So now we want to understand the effects of property in the Sydney market, and I've got Jay here to maybe enlighten us a little bit more about the conditions of the market and maybe elaborate a little bit more.
Yeah, as always, thanks for having me, Tuan. COVID-19, I mean, this is an unprecedented event, like you just said. It's not something we've seen before. There have been pandemics, that have gone throughout the ages. There have been recessions, which we're currently in one now. So we do have data to kind of help us get a bit more of an understanding as to what to expect. But we definitely are in uncharted waters. I would say the main effect that we have seen from COVID-19 is fear. It's the main effect. And fear and greed are the two main drivers for human actions. People to do things, especially when it comes to buying or selling property. So I think the fear is definitely the main thing there. The two benefits though, or the causality of that fear at the moment has been that there is much less competition of people wanting to buy property, which is a great thing if you are a potential buyer, okay? The other thing too is that sellers, their confidence is low. Again, if you're a buyer, that's a pretty good environment to be in. So I would say those are the two biggest things we've seen. In regards to volatility of pricing, different suburbs have seen their own volatility. Across Sydney as a whole, we've seen a 2% decrease in price over the past quarter. But to put that into perspective, we're still up about 13% since this same time last year. So we've got a lot of buffer room there as well. I would say that if you want to get a better understanding, you need to do your research. Different suburbs are going to perform differently. And the biggest thing that I have for people that I think they need to understand is that if you're waiting for bargains, you've got to remember that as volatility increases in the market, the appetite for banks to lend will decrease. So you might end up finding that property that you really wanted to buy and you waited and you were smart to wait, but now the bank's not going to lend you the money to purchase that property. So you've got to take all those risks into account because property should always be a long-term buy and hold, nothing that should be too short-term.
Great, and that's great information, especially in this pandemic we're going through at the moment. If you have any questions at all, reach out to us here. It's Tuan from Tax Quantity Surveyors, and thanks for tuning in.